I want you to develop a deduction mindset. What we're going to be discussing is, if you're an agent, you're going to have proof of that deduction. We're going to be discussing your auto expense, meals and food, home office, gifts, clothing, and the biggest middle-class tax credit in the history of the universe, the qualified business deduction. Number one, you need proof. You know the number one reason real estate agents do not get their deductions, or small business owners in general, is because they lack the proof to take it. They're busy, they're doing things, they lose the receipts, they forget about it. They just don't have the proof at the end of the year, and a lot of times they just forget about it. So what I want you to do is get the deduction. If you're a real estate agent, every $100 that you can deduct, that you can legally deduct, is going to save you about $40 in tax. That's a heck of a lot of money. In many states, it's probably pushing 50%. That's because the primary reason is we pay Social Security and Medicare, called self-employment tax, on our self-employed earnings. And that's an additional 15.3% over top of whatever your marginal tax rate is. So it saves you a ton of money. However, according to the law, if you get arrested for something, God forbid, you were innocent until proven guilty. However, in the eyes of the IRS, if you do not have proof of a deduction, you don't get the deduction. No proof, no deduction. All right, so what I want you to do, I want you to start thinking about that $40 that you're losing by not remembering or recording that $100 expense. I want you to develop a deduction mindset. That means also knowing what's deductible. You need to know what's deductible so you know what to save. Also, I want you to start keeping a manila envelope. I don't have one around here, but just like a 10 by 13 manila envelope, put that thing in your car. Put it down between it, put it somewhere in the car, but usually like between the seat and the middle console there. Stick it in there. Every time you go to a store, put your receipt in there. If it's for business related, put it in there every time you get gas, whatever. That way you don't lose it. Also, you can buy items online. If you go to Amazon or another online provider, you can go back later and get your receipts from certain purchases. Don't mix your personal and business purchase together. If you go to Walmart or somewhere and you're buying just items for the house and you also get some stuff for your business, make 2 purchases. I know it's a hassle, but you're going to lose the receipt. You're going to lose the deductions. Every $100 saves you $40. You earned that $40. Instead of giving it away for somebody to waste it, such as the government, you get to keep that money. Keep a separate checking account for your business. Also, if you use a credit card, only use one card. It can be a personal card. I don't care what it is. If you're not a corporation, it doesn't really matter. But have a separate credit card and only use it for business purchases. Also, if you have any questions or ideas on how you keep receipts or how you track your expenses, please feel free to share it in the comments below. We'd love to hear it. Let's move on to auto. Let's move on to your auto deduction. It's your largest deduction for self-employed real estate agents. Your mileage rate in 2025 is 70 cents per mile. That's quite a bit. I want to remind you that 33 cents of that 70 cents, however, is for depreciation. We're not going to discuss that a lot, but that could conceivably come back to bite you in the end, because if you sell or trade in that vehicle, it could create a taxable event, which it doesn't really often because things depreciate so fast anyways. However, it could. You want to remember that. Also, you can do actual expenses or the standard mileage rate, which I just gave you. But if you use actual expenses, you need to track all of your expenses. And don't forget your interest on your loan. If it's an American car, you might be bought it in 2025. You may be able to deduct that interest somewhere else. But you don't want to, because you want to deduct it on Schedule C, where it also decreases your self-employment tax. All right. But then you got to track all expenses. Gas, insurance, repairs, maintenance, all that. And it's kind of a pain. However, it can be a bigger deduction for a lot of people, especially when you're using an expensive vehicle that's used only for business. It also could conceivably qualify for bonus depreciation of 179 expense. That's a whole nother topic, which we do discuss in our real estate tax cut library. Be careful with those depreciation. Those get highly technical. All right. What I want you to do also, remember, you got to keep a mileage log. Technically, you're supposed to have a contemporaneous mileage log. Do it. I know it's a pain. Please do it. You need to know where you go, where did you go, and why did you go there? How was it business related? The IRS would want to know that for every trip. There are a ton of apps out there for realtors now that'll help you do that. Basically, just get on your phone, you push a button, it'll track all your miles for you. If you're too lazy or too busy, or you think you're too busy, at least for crying out loud, keep a calendar. Just have a calendar with where you went in it, where you went on that day, and then you can always go to MapQuest or something later, figure out the mileage. At least then you got something. All right? At least then you got something. But you really need to keep a contemporaneous records. However, this might work in a pinch if you don't have anything else. Also, particularly if you're taking actual expenses, make sure you take a picture of that odometer every year so you know what your total miles is every year. You need to track your business miles, commuting miles, and total miles for the year in order to complete that tax return. Let me back up a little bit. Business miles is most important if you're doing the standard mileage rate. However, if you're taking actual expenses, you need to track commuting and total miles. You need to be real accurate with those because your deduction is going to be based on the percentage of business use for those actual expenses. All right, let's move back forward into deductible trips. What's a deductible trip for your business? All right, basically, the primary reason for the trip itself is business. You're there to conduct business. Generally, it's important enough to be on your calendar. You know where you're going the day before. You know what you're going to do. It's just not a whimsical trip. You go somewhere and then business kind of falls out of the sky. Can't happen. Not a lot. Generally, it's important enough to be on your calendar. It's also easier if you have a home office, which basically makes every time you leave your home office for business, that makes it a deductible business trip because your home office is your primary work location. We'll discuss that in a few minutes. However, most showings and trips will qualify for the IRS as a temporary business location, so those miles would qualify also if you're leaving from your home. However, if you go to a particular rental office every day and start there for your day, or maybe 3 days a week on a set schedule, that's called commuting. Those miles are not deductible. All right, here's a few auto reminders. If you expense your vehicle, be careful because of your business use of using actual expenses. If the business use falls below 50%, it could create a taxable event, particularly if you use bonus depreciation of 179. Keep that in mind when you're tracking your mileage and also if you're claiming actual expenses. Selling and trading in or trading in your business vehicle can create a taxable event. I just want to make you aware of that. Remember, we discussed the 33 cents per mile depreciation. Please have a log just to finalize this out. Just need to go where you go and how was it business related. All right, let's talk about meals and food. Another big deduction for real estate agents because you're always shucking and jiving. You're out there, you're making deals, you're meeting with clients, you're meeting with each other. Got to deduct those meals. Business meals remain deductible at 50% for 2025. I have an asterisk there because there's a lot of confusion about this. There's a lot of sources saying for 2025 and 2026, they're 100%. As far as I can tell, we don't have regs on any of this, but as far as the law itself goes, they're still at 50% as far as I know. But I did put an asterisk there just in case. All right, what's a qualified business meal? I'm going to tell you what a slam dunk deductible business meal is. Here it is. You're meeting with a business associate or a customer or a client that has a business purpose. Your primary purpose for being there is for business. It's kind of like basically it's a business meeting where you happen to eat. This meeting requires some level of preparation. Doesn't have to be a lot, but you're preparing to be there because you know you're going to be discussing business. It's important enough to be on your calendar and, very important, you pay for the other person's meal and you also pay for your meal. If you do all that, you have a slam dunk deductible meal. Now, it doesn't mean other meals can't be deductible because they can, but that's a slam dunk meal. Key is primary purpose is business. You're with another person. You pay for both meals. Meals alone, however, are never deductible. In our book there, we do go a little bit, has like a little loophole in that. But primarily, they're generally never deductible unless you're out on overnight travel. So your coffee, your next network event, wherever you go, let's say you go to a networking event every week, you only buy your own food, you only buy your own coffee, that's not deductible. However, if you buy it for another person, yeah, that meal will be deductible. And remember, it's 50% because you're basically paying for the other person's meal. So trade off. It's a good way to get a deduction. All right. Remember also, there are some food that you can deduct as 100% deductible. Food and snacks for an open house. Remember that's 100% deductible because that's more of an advertising expense if you think about it. It's not really food per se. You get that food there, so people come in. Food available to the general public. Now, your employees, you may snack on it from time to time. Who's going to stop you? But that would be like food in your lobby for people come in, coffee in the lobby, that sort of thing. Staff meals, if you're keeping somebody on the job, doesn't really apply to realtors so much. But if you're keeping staff on the job to finish a project, you can deduct 100% because you're keeping them there so they're not running off to go to restaurants or running off or to go home. You're keeping them there. Maybe they're working overtime to finish a project. That can be 100% deductible. Regular meetings, however, if you just have a staff meeting once a week or something like that, you're paying for some food, bringing in some food, 50%. Annual party, however, can be 100% deductible. So if you have an annual Christmas party, I'm recording this right around Christmas time. You might be watching this near year end. That Christmas party can be 100% deductible. You're only having it once a year. It's a big event. Proving your deduction. This is most important for meals because you need to know when did it happen. Keep your receipt. Where was it at? Keep your receipt. How much did it cost? Keep your receipt. Here's what you need to do though. Who were you with? You need to write on that receipt or have it in your calendar. Who were you with and what did you discuss that was related to business? Let's move forward to the home office deduction. That's my office, which you can see behind me, but you don't see the rest of here. It's pretty bad. Qualifying home office. All right. I'd like for you to have one of these if you can. It's not a giant deduction. For renters, it can be a big deduction. But anyways, have one if you can. It just makes your mileage a lot easier. But yeah, qualifying home office, basically it's used to perform administrative duties. Most realtors don't have another home office to call home. Most of you guys are working from your house. You're doing scheduling, research, etc. from your house. You have no other fixed location to perform these duties. We may have a realtor's office or a broker's office, but not a lot of realtors spend a lot of time there anymore. You're primarily at your home doing the work you need to do for your clients when you're not driving those million miles a year. Used regularly for business, so this location needs to be regularly for business, and this is very important. It's used only for business. It could even be a part of a room. It could be a part of a room with a desk, a chair, and a filing cabinet, a computer on it, or you put the laptop there when you're working. That will also qualify. So it would just be that area around that desk that would be your home office in a separate room. You can take actual expenses for the home office or the standard mileage rate. You take actual expenses. Okay, back to that. These are costs directly related to the home office area. And also you can take what's called indirect cost, which is a percentage of the shared cost. Downside here, you must depreciate your house or office. That little percentage of the total square footage of your house needs to be depreciated if you're claiming actual expenses. Now, it could come back to bite you later as a very small tax, even if you get the exclusion for, not to pay tax on your capital gains. All right. You also have the standard mileage rate, which is really cool. It's $5 per square foot. You don't have to depreciate your house. You can still deduct interest on your, itemized deductions for your interest and property taxes. It's up to 300 square feet for a $1,500 max deduction. That's a pretty good deal. All right. Now, this leads us to believe there's always been this rumor out there, this gossip that the home office was a red flag. It's not a red flag. It's no longer a red flag. I don't know if it ever really was, but the problem is people later couldn't prove they had a home office. That's what you ran into. And what you need to do is have proof you actually have a home office. If you have a picture, take a picture with your phone, take the JPEG, email it to yourself, save it in the file with your tax items. That way, if you ever need it, you can say, hey, here's my home office. Even if you're not using it anymore, here's your proof that during that tax year, you had a qualifying home office. All right, let's move to gifts and promotions. All right, gifts. These are items given away to customers and colleagues. Let's call these closing gifts that you give your customer. Maybe you're putting in a mailbox for them. Maybe you're getting them a wreath for their door. Maybe a door knocker with their name on it. Maybe you're getting them a home warranty, which, by the way, is a great gift for a real estate agent to give their customers. But there's a big loophole. All right, well, let's go through some examples. Fruit baskets, calendars at the end of the year, closing gifts and thank yous. I should have moved through these earlier. And then also we're going to be discussing promotional items, freebies. That's stuff you have with a logo. Your coffee mugs, your pens, whatever, what have you. Tote bags, that sort of thing. Now, you may not know this, but there is a business gift limit. It was established in 1962 to limit excessive gift giving. However, they created a limit, and that limit was $25 per person, which in 1962 was a good bit of money. Here's what you need for proof for your gift. Track the recipients of the gifts. You need a receipt, the recipient's name, and why did you give it to them? What was the business purpose? Now, remember I mentioned that $25 limit? There can be a loophole for this. To me, it makes sense. I think it would work, but you notice how the asterisks around it. So this is not advice. This is just an idea. Run it with your own tax folks. But if you put that gift on a closing statement, let's say you buy somebody a home warranty, you put a mailbox in for them, or home warranty is kind of cool because closing attorney can just usually just mail the check to the warranty place. But whatever you're doing, if you put that on the closing, that gift on the closing statement as a deduction in your commissions, that's really a deduction in your commissions. It's like you're giving a refund in the form of a gift. So I think that would fly and beat the $25 limit. So keep that in mind. Maybe I just gave you a great idea right there, but keep that in mind when you're dealing with your customers. All right, promotional items. Let's go through these real quick. Established in 1986, $4 per person. Today's value, that would be $12 per item. And I'm sorry, $4 per item, not per person. Let me correct myself. If it's over $4, you need to track the recipient because it goes into that $25 gift limit. Very important. So you're limited to $4 per year. As I said, it ties to the gift limit. So there's a little bit on your promotion list. Now let's talk about clothing real quick. Clothing that's suitable for everyday wear. If you could wear it to church or you could wear it to a wedding, it is not deductible. This would include suits, dress clothes, etc. are not deductible. However, safety attire can be deductible, like Kevlar suits, your vest, your reflective vest for walking along the road, what have you. Those can be deductive safety items. Now, if you want to deduct your clothes, you need to turn them into a uniform. And the easiest way to do that is you slap a logo on it. You take a not deductible there, coat of many collars there that Kramer's wearing, and you can turn it into a stylish shirt with a logo on it, like Laverne. Laverne's shirt would be deductible because it is branded with her logo. All right, let's wrap this up with the qualified business income deduction. And I hope you guys know about it. I hope you do. But the QBI deduction, as we pros like to call it, let's take this into perspective. Most small business owners earn far less. Most small business owners are lower middle class. But most of us earn $150,000 per year or less. They are the bedrock of society. They are a bedrock of our economy. But most of them really are, most small business owners, but they earn less than $150,000 per year. This makes the QBI deduction, the qualified business income deduction, the largest middle class tax cut in history. And let's get to what it does. I should have said this a long time ago, but what it does is it allows business owners to deduct 25% or 20% of their profit from their income. That's a big deduction. It's available to sole proprietorships. That would be Schedule C. Partners and S corps can get this. Owners can deduct 20% of the profit from income. So let's make you make $100,000 a year profit on your tax return. There's some adjustments in there. I'm not going to get into all that. But roundabout, you're going to get a $20,000 deduction. That just saves you $4,000 in tax. All right. Mainly federal tax, doesn't really save you on the state because of the way it's calculated. But $4,000. If it went away, you would notice that $4,000 increase, wouldn't you? Yes, you would. Yes, you would. I said, to repeat myself, partners, S corps, sole proprietors. There is a phase out. However, for most small business owners, it's not going to impact them because it doesn't start. It's adjusted for inflation. It doesn't start until $197,000 if you're single, roughly $395 if you're married, filing jointly, and that's for 2025, and it's adjusted for inflation. You can still get it if income's higher than that. There's a phase out. However, it just gets more complicated. It goes into the basis of property and W-2s and all that. We're not discussing that here today. All right. Hey, we're getting close to the end here. So what I want you to leave it with is a question free for all. If you have a question, if you're a real estate agent or anybody else for that matter, leave a question in the comments. We hopefully we'll be able to reply to you, or maybe someone else who's a good subscriber to our wonderful page. Maybe they'll chime in there and help you out. Check out our playlist for more tax and business tips. And as always, if you want to dive deep and really learn something, go to overnightaccountant.com and check out our courses.